So now we're going to talk about inventories. There are two types of inventory systems: perpetual inventories and periodic inventories. This relates to how we record our inventories. If you have a perpetual inventory system and perpetual inventory records, this means that the inventory record for an item in your inventory is updated each time an item is purchased or sold. So you can look at it at any point in time and know exactly what you should have in the warehouse. Most companies today operate on a perpetual inventory system. There's also something known as a periodic inventory. This means that we do not update the records when the purchases are made or the sales are made, but we go out at the end of each month and count on hand physically what we have in the warehouse, and then we adjust our inventory balance to reflect that. This does not give you a very good basis for managing your inventory during the interim period of time. Now, even though some companies may have a perpetual inventory system, once a year they may go out and make a physical count to make sure that the count in the warehouse ties with their perpetual records. And normally they'll find some adjustments they have to make. How do we cost our inventories? Well, there's several ways to do it. One is called specific identification. We identify the cost in every single item in our inventory. For example, an automobile dealer would do this. They would identify every car that they have on the lot with a specific number, and they would identify the cost that they paid for that vehicle. Now, where you have larger quantities of items in inventories, let's say that you're in the business of handling lumber. So you may choose then to value your lumber based on what's in the inventory as a batch, not by specific identification. And there are three ways to do that: FIFO, LIFO, and average weighted cost. In FIFO, we value everything in the inventory as if the first item that came in was the first item sold. So the inventory would be priced on the cost of the last item that you purchased of that particular type. Under LIFO, we value it on the last in, first out. So there we would say that the last item that came in would be the first one going out. So that means that you would value your inventories more likely on the price you paid for the item in some previous period. Average weighted cost means that you average all of what you paid for the items, all of them in the batch, and come up with an average of the cost to assign to each item in the inventory. All four of these items are acceptable under GAAP for inventory valuation purposes. We also have some inventory ratios. We have inventory turnover and average days on hand. We want to turn our inventory over as fast as we possibly can, so it becomes accounts receivable, and then we want to return the account receivable over as fast as we can to get it back to cash. So here we're assuming our cost of goods sold last year was $1 million, and our average cost of the items in our inventory is $250,000. Now that cost may be the FIFO value, it might be the LIFO value, it might be the weighted average value, or it could be the specific identification. But the total inventory is valued at $250,000. The turnover is calculated by dividing cost of sales by the average inventory. So here you see we get 4 turns. So this means we turn our inventory over 4 times during the year. This is a very good turnover. But again, the inventory turnover would depend on the type of business you're in. For example, if you're in the nursery business, it might be you only get 2 turns a year, or maybe 3 turns a year. Other businesses, you might get 6 turns a year. Again, you have to compare your turnover with what is the industry average. Then we want to know what are the days outstanding. So we take 360 days divided by the turnover, which is 4, and we get 90 days. So on the average, we have 90 days of inventory in the warehouse at this point in time. Another current asset is a prepaid expense. A prepaid expense is the amount that has been paid in advance of when something is due. And then once we pay the expense, we reduce the prepaid item and charge it off. For example, a company may buy its fire insurance policy on January 1 for 6 months. We want to write this off over the life of the policy so we properly match our revenue and expenses. So we book it as a prepaid item when we pay the premium, and then each month we will write off 1/6 of the premium for each of the 6 months. So at the end of January, we will have 5 months left. At the end of February, we'll have 4 months left. At the end of June, there'll be nothing left in the prepaid insurance account. Again, this account allows us to properly match our expenditures against our revenue on the accrual basis.